A lot of the factors that concerned everyone before the CPI print last week are still there, and we're still concerned, of course, about very high multi-year levels of inflation. But has anything changed since that print last week in terms of how you want to allocate money?
Not materially, in the sense that I think it's reasonable for investors to be thinking about a slightly different path of monetary policy from how they were a couple of months ago. But to some extent, this is all still consistent with what Powell said at the last press conference for the Fed, where he did talk about potentially downshifting the pace of hikes, but he was saying that at the same time as there possibly being a higher terminal rate. So I think investors have to bear that in mind. And while we may see the immediate braking effect on the real economy taken out, we still need to be prepared for higher rates. So for us, the fixed income markets are still an area where we are seeing better valuations, but still need to tread with a bit of caution. I think we do still see a bit of a tailwind behind the US dollar, which is perhaps a less popular view than it was, but for us hasn't really changed. And I think in terms of the outlook for the equity markets, as you mentioned, I think we need to look at how much the fundamentals have really changed, particularly on the demand side. And demand probably gets more challenged, particularly in margins, before it gets stronger.
You must look in front of your multiple screens every day and say that is just the wrong price, whether it's an asset class, whether it's a sector. What is it that's completely the wrong price at the moment? Everyone's got something they think is the wrong price. I just wonder what it was for you.
Well, I mean, one hesitates to almost be too kind of arrogant in terms of saying, well, the market's got this wrong. Having said that, sometimes you see things which just seem internally inconsistent. And I think one of those internal inconsistencies right now, if we stick with the Fed for a second, is to say, right, so the Fed is going to downshift to, let's say, 25 basis points a quarter, I think is really what the market is looking for now in the first half of next year. But that they're also going to have to start a fairly rapid cutting cycle in the second half of the year, so cutting rates by 50 basis points by the end of the year. Something that doesn't smell right, in the sense that either the Fed will not downshift and then potentially they stall the economy, or they will downshift, in which case, what's the rush in terms of cutting? You'd probably need to believe that they have already done a lot of economic damage to make sense of current pricing, and we don't really see that.
One of the challenges, it seems, Sunil, is matching the longer term with the shorter term at the moment in terms of market performance. And Goldman Sachs had a terrific piece on how market levels now are forcing a whole swathe of those shorting the markets to cover those shorts. And I think Goldman Sachs were talking about $79 billion of net buying over the next month as those shorts move to cover positions. That obviously, for investors who've listened to a narrative of recession and markets going down on the back of tighter Fed policy, that's going to look very strange over the course of the next month if we only see market indices grind higher at this stage. How do you take advantage of that?
I do think it is going to look strange, but we need to remember that even in a sustained bear market, you do get some brutal rallies. A good analogy for us is the drawn-out decline in markets from 2000 to 2003. And at that time, you saw a large number, I mean, more than half a dozen rallies in excess of 10%, let's say, in the US index. So I think investors do need to be prepared for that. At the same time, short covering, I think you're quite right. I think there is quite a bit of evidence of it, and not just in the stock market. If we look at a number of trades, whether that's relative value within the equity market, some of the more defensive parts of the market, or the performance of currencies and the weakness of the US dollar, they do smack very strongly of short covering, which can be violent, but tends not to be drawn out for months and months.
Technically,
hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.